And then that will be perfect. So today's topic is leveling up your real estate in 2026. And what we're going to be specifically looking at is the tax changes every investor needs to know. Some of this is going to be a review. A lot of this might be new. And so let's dive in. Just so you guys are aware, the two speakers today, you have me hosting. You guys probably all know me. I would assume a good amount just because a lot of this was through our channel. My name is Sosi. I'm a certified mortgage planning specialist, certified liability advisor, trained in divorce and real estate. And I've done a bunch of certifications to do one thing: level up myself in how I give advice through my mortgage practice. And so I've really specialized in financial planning through real estate, trying to learn everything I can learn from a tax, retirement, estate planning standpoint, and bringing that into my side of the balance sheet, specifically on the liability piece. And so I'm really, really honored to have Barb. And Barb, I'll let you introduce yourself. But again, as a preempt, Barb is the #1 tax strategist in the country. And more than anything, she's just really gifted at taking boring, complex topics and really humanizing them in a easy to assimilate way so that people can make more money for their family and keep more money in the legacy they're creating for their family. So Barb, if you wouldn't mind, share a little bit about yourself.
Yeah, for sure. Thank you for the kind words. I'll go back and listen. But I also want to introduce Sosi because he's so humble, and he is also the #1 loan officer in his company. And so he also knows what the heck he's doing. And Sosi has personally helped me and my family probably over $10 million in loans he's done for us over the years. And he has saved us a lot of money. And he's done no cost refis for us. He's done so many things. And so you're in for a treat as well for him. But if for those of you that don't know me, since you are on here with SOS, you can just follow me at Your Tax Coach. And I drop daily tax tips and tricks, and you can just better know taxes and save more money.
Heck yeah. And by the way, this was a picture done at 2 years ago, 3 years ago. This was the first one, I think, Barb. 3 years ago, Minted Wealth Live. And so it just passed. You guys missed it if you weren't there, but follow Barb so you can sign up for next year because it's a life-changing event. All right. Today's agenda. First, we're going to review some of the basics and updates for these specific topics. So first, we're going to talk a little bit about standard deduction. So if you're taking notes, feel free to outline it in this manner. Standard deduction, mortgage insurance and interest rate deductions, SALT deduction, the cap for it, which if you guys aren't aware, SALT stands for state and local tax deduction, capital gains on primary home exclusion, inheritance, opportunity zones, depreciation will be our fifth topic, which is one of the biggest highlights. This is literally how, I've even seen clients write off $4 million of W-2 income through the bonus depreciation, and their portfolio is very different. Hospital buildings, like crazy stuff, but this is going to be really fun for all you guys to kind of learn on. And then housing credits and community incentives. This is going to be a very slight piece that we'll talk about, but when we go through that subject, I think you see why we're bringing it into context of today's topic. And then in addition, right, how do we actually understand all these, book type topics? It's going to be through examining real life scenarios. So we're going to go through those who will rent their current home by another, meaning a new primary. What should we be aware of from a tax standpoint? Two, if you're cashing out on your home, right? Let's say you're in your house. Do you want to live in long term? You're 10, 15 years in this house. What about all the equity you've grown? If you've thought about pulling some out and using it for an investment property, what do you need to know there? And then lastly, for the person who might be an experienced investor who has a few homes in their portfolio and they're thinking, what do I need to know? I'm not planning to add anymore. How do I fine tune my portfolio? We're going to talk about that today too. So with all that shared, that is our agenda for today. And to get straight into the first section, basic and updates, let's go into the standard deduction. This is just some highlights. We don't have to read through. If you guys want to read on your own, that's totally great. But I'll just share a little bit on my piece with standard deduction. Barb, from everything I've seen with the standard deduction, right, we've been able to solidify. We have a lower tax percentage than we did before this tax reform came out. It's now been made permanent. And it seems to be the coolest part of it is the fact, not just that we have a lower percentage by like 2 percentage points, I think so it was from a tax standpoint, but the gap in between the tax brackets is solidified in a better position, especially it seems like for the middle class, if I'm understanding it correctly. But again, always open and wanting to learn from you on it. But here's what I'm wanting to bring to the topic on this. Standard deduction has some perks, but here's the takeaway. It's not going to be your save all in protecting your taxes from going to Uncle Sam. So there are some perks to it, but it's not going to be everything. There has to be things added to your tax strategy, which is why I'm excited to use this as kind of a prime for the pump of the topic of real estate. Barb, what would you add or share anything on this?
Yeah, the standard deductions have gone way up over the last couple of years. So that just means the IRS is giving you a certain amount each year that you can deduct from your income. So this year, for example, it's $15,750. Double that if you're married, so it's $31,500. Automatically gets taken out, like whether you're W-2 or a business owner. So if you make 100K and you're married, you can take out 31,500, and then you're taxed on the rest of that. So really, yes, they give that to you, but to Sosie's point, you want it to be higher than the 31,500. And one of the ways to do that is with mortgage interest. So I'm sure we'll talk about that in a minute.
I love it. Yeah, let's go straight into it. So mortgage interest and insurance deduction. Give us any other good news updates on this. I got really excited when I saw, so I can't wait to see what everyone else thinks.
Yeah, so you can now write off mortgage interest only up to 750K. So for those of us in like, if you're in higher, cost of living states like California and New York, you're definitely going to have loans higher than the 750, but you can at least write off interest up to that. And now you can write off, well, starting next year, you can write off PMI, which is private mortgage insurance. A lot of people have that because of the down payments that they chose for their loans. So she knows more about when PMI is needed, but now you can write that off and it'll become deductible just like mortgage interest would.
That's only to the same loan limit.
Is.
Okay. So, guys, one thing to kind of know on this that most people don't understand because it's against conventional wisdom is people think, hey, if I put more down, I get a lower interest rate on a primary residence. That is true if you're putting like 25% down or more. But when you compare a 20% down loan to a 15% down, or compare it to a 10 or a 5, or even a 3 if you're a first time home buyer, your interest rate is actually lowest with the lower down payment as of about 2 years ago when the federal government kind of changed the regulations, because the thought there was they're trying to give lower down payment first time home buyers a fighting chance. So they're trying to give them lower loan level pricing adjustments, which in English just means lower rates. So do note this, that if you are looking, and when we talk about this here in a moment and the real life scenarios, putting less down, even though it gives you mortgage insurance, if you're a high credit score borrower, your mortgage insurance might be minimal, but you could get a lower rate, have a lower mortgage insurance. It's going to be temporary, maybe, 2 years max is most of these pieces right now if you're putting closer to that 20% down. And then from there, you still get the tax deduction. So just keep that in mind in your mortgage planning. Don't throw the baby out with the bathwater just because conventional wisdom makes you think that putting 20% down is better. Sometimes putting a little less and getting mortgage insurance, especially now with the tax write-off, could actually give you more savings in the long run. So I really, really love that. I'm excited to see what that's going to do for homeowners here coming up. One thing to add there, Barb, from my understanding, state allows you to write off more interest or interest on a higher loan amount. Is that correct? In California, can you write up to $1 million state taxes?
California, but that's the only state.
Dang it. Well, at least we got one thing going for us outside of the weather. All right. So next is going to be the salt deduction cap. Would love to learn what has happened here because this has been a big topic.
Okay, so this is one of the tax law changes I really did not like in 2018. When Trump was first in office, we had a huge tax law change there. And this is when I was like, why did you do this? So prior to 2018, you were able to deduct any state taxes that you paid. This was great for people like California and New York that have really high taxes. So if you were paying 100K to state taxes, you could deduct 100K on your itemized deductions. Then in 2018, they capped it at $10,000, which was like nothing. Like everyone pays more than $10,000 in state tax unless you're in like Texas or Florida. So this really sucked for a lot of taxpayers, even especially W-2 earners. They increased that this year, thank goodness, but it's still only 40,000. So for a lot of high income earners in California or New York or Illinois, you might still be beyond the 40,000. But at least they did up it from 10 to 40. And they put an income limit on it, which is also a bummer. So they're like, yeah, you can deduct 40, but only if you're making less than 500K, which is silly because it's like you're probably not paying 40 if you're making less than 400K. So that didn't make sense to me, but at least you can write off a little bit more. But if you're a business owner, you have to know this tax strategy. So business owners can get around this rule in most states. So California, you're allowed to do this. Arizona, you're allowed to do this. Any of like the big major states that we work in, you can have what's called a pass-through entity tax, where your business pays for all of your state taxes, even on the personal side, and can get a business deduction for it. So make sure if you are a business owner that you know about PTET.
PTET. So if you're taking notes, PTET. Barb, question on this. When we're talking about making more than $500,000, especially for self-employed individuals, are we talking about after deductions? Or how does, can you just clarify that a little bit for me?
Yeah, it's usually based on AGI or modified
Okay.
AGI, which is your adjusted gross income. So that's after a bunch of deductions.
Okay, cool. Sweet. So hopefully even for those who are able to use some tax strategies there, you're able to get a little more tax benefit. I mean, for me, I'm pretty stoked on that just because of the different pieces that we've learned on it. So little savings in the long run. Capital gains. This is a real fun one. And, I will share the most amount of trolls I've had have been on posts where I talk about, trying to look at selling. If you're gonna sell your house within the next 5 years, contemplating selling sooner than later, especially if you have a low interest rate. And I know it's counterintuitive and it makes people feel uncomfortable. So like, why would I ever trade a 2.875? Well, you just told me you're going to trade it at some point within the next 5 years. So why gamble for it to be traded up to a 7% where you can trade it for a 6 and have the highest chance of trading it for a 4 or 5 if with refinances coming up between now and year 5. So all that to say, it's definitely a big conversation I have, but I wanted to share that because people have really fought back on the capital gains pieces. I've heard a lot of people try to say, okay, if it exceeds $500,000, you could just do a 1031 exchange, and they don't really understand the differences there. And so I'd really love some good feedback here as far as what in the world are capital gains and, how do they apply per property?
Yeah. So for personal residences, if you're selling it for more than a $500,000 gain, if you're married, you are going to have capital gains tax. But the IRS does give you 500K tax free. So if you bought your house for 500, you're selling it for $1 million at least 2 years later, then you can sell it for $1 million and pay nothing in taxes. If you're married, if you're single, it's 250. So you could sell it for 750 and still pay nothing in tax. Now, if you're beyond that, you still might be in the 0% capital gains tax bracket. So a lot of people just think you're like automatically in that 20% rate above that, but it might not be true. It's going to depend on your income, what types of income you have, and how much capital gains you have. So really the taxes would be so minimal. Like let's say you bought a $500,000 house and you're going to sell it for 1.2. The most you would pay in taxes is 40K and you just made 700K. And that's like very worst case scenario. So like don't be afraid to sell your house. It like you will become a multimillionaire if you just sold your house every 2 years and like went somewhere else and used that equity to buy more. So utilize the primary home exclusion for sure.
Yeah. And one thing to add on that too, and please affirm this if applicable, right? I think a lot of times I've seen people just use a very basic aspect of that, like, oh my gosh, I'm selling it for this and I bought it for this. Well, number one, I think a lot of people confuse what you're netting as far as your proceeds to what the capital gains are. They don't understand that it's based on the new sales price compared to the original. But the other piece there is they forget to keep receipts or keep track of upgrades they've done to the home, right? So those upgrades, if you've done $100,000 of upgrades, that should reduce the basis for you, if that's the right terminology. And then as well, selling commissions, the cost of selling the asset. Would you mind kind of clarifying for everyone what those two things will imply for capital gains on a primary?
So I'll use that same example. You bought it for 500. Let's say you put 100 into it because you needed to remodel a bathroom and it needed a new roof eventually, whatever. So your basis is now 600,000. So it increases your basis, which is what you want because you're only taxed on the net minus your basis. So let's say you did sell for 1.2. Let's say after all closing costs, commissions that you paid, anything that you had to pay out of pocket, maybe you, after all that was 1.05, so $1,050,000. Your gain is only $1,050,000 minus 600,000. So now you're at 550 and you get to exclude 500. So your gain's only 50K. So the most you would pay in taxes on that is 10 grand.
I love it. That's so good. And then what about inheritance with any of these? Like if I'm inheriting a property from a family member and they bought it for $200,000 in Huntington Beach and now it's worth 2 million, what happens in my world there?
Please don't ever, ever, ever let your parents give you your house or their house before they pass away. And vice versa. If you're a parent, please don't ever give your children your house until you pass away. Because when you pass away and someone inherits it, they inherit it for the fair market value on the date that you passed. So to Sosie's example, you bought a house for 200K. It's now worth 2 million. When you pass away, your kids or whoever is inheriting it will get it for the fair market value of $2 million. So they could sell it that day for 2 mil and pay nothing in tax. But if you gave it to them before you passed away, they get it for the value you purchased it for. So they would get a $200,000 basis. So when they sold, they'd have 1.8 million in capital gains that they would then have to pay capital gains tax on. And it affects your gift and estate taxes as well, because you just gifted part of that 15 million exclusion that you get. So please don't ever let your parents gift it to you before. What we see often is, like, as parents age, they don't want to deal with a big house. They want to downsize. They want to, maybe they need to go to assisted living or something like that. Still don't let them gift it to you. Maybe you're now just the property manager and you lease it out until they pass away. It's still more tax advantageous.
I love it. And to even throw in an additional piece there for everyone to consider, if you are trying to be a responsible parent and plan for your child to inherit this, because you're hearing about this maybe for the first time, and then you also hear the new update that happened with your inheritance ability. I believe it's up to 15 million is what you can inherit without taxes, and 30 million from married couples. But if you're hearing all this, keep in mind, creating a trust is so important. One of the things I learned the hard way this last year from Barb was, my father passed away about 17 years ago, and no one did anything on the piece. And so now the house is in probate and all this stuff, but I'm not going to get the capital gains of what it was sold for today, right? It's when it was inherited. And so the sooner you have a trust, so that none of the probate and people trying to prefer one another and help each other out for years unknowingly, get that trust set right away, because it's so important to do so. Barb, anything on opportunity zones we should know? And for those who are on this call and don't understand what opportunity zones are, if you're an investor, this is super important. And if you're a realtor helping people learn how to grow their real estate portfolio, it's imperative to know this.
Yeah, I've seen real estate deals crumble or succeed simply because of opportunity zones. So what an opportunity zone is the IRS has identified somewhere in every single state that they want gentrified. So they've identified somewhere it might be a little ghetto, a little run down, poverty stricken, and they're like, we really want to build this up. We can't do it ourselves as a government. So we're going to incentivize taxpayers to do it for us. And in turn, we're going to let them have some capital gains tax free. So any of you listening, if you have any capital gains this year, whether it's from selling a house, selling crypto, we all know crypto's gone crazy. So if maybe you sold crypto for a gain, stocks, RSUs, any capital gain, you take that capital gain, you pour it into an opportunity zone. So an area that has been identified. Maybe you find an investment property there for 100K. So you throw your 100K capital gains into it. You have to spend at least the purchase price on it to make it better. So if you bought it for 100K, you got to spend 100K to fix it up. And then the IRS says if you hold it for 10 years, you can sell that later completely tax-free. So not only did you get your capital gains that you put into it tax-free, that 100K property you bought is probably going to be worth like $1 million. You're going to sell that tax-free. And in the meantime, since it's an investment property, you're probably going to do a cost seg study, take all the depreciation, and now you just got to take all the depreciation tax-free and not have to recapture it later. So really great tax strategy. It's like a triple tax benefit We love them. So definitely, if you're buying a property, look online if where you're buying it is an opportunity zone, but be careful because it'll be like one street is and the very next street isn't. So just be super cognizant of the address.
I love that. So if you're taking notes, put a little mark on. We'll talk about this in the fine tuning your real estate portfolio piece, but realize how this is already playing, right? As far as some of these building blocks, we're talking about concepts that save you money now, and then we're talking about how you don't have to pass on any cost implications to the next generation, and they still get to save them too. So it's literally a double dip in savings if you do this appropriately and correctly by prudence and planning ahead of time. All right. So next topic, we're going to be going into, this was the what changed in the 15 mil to 30 mil. So just to kind of show there your estate and gift tax. Actually, Barb, I'd love to have your take on this because we get questions about this all the time. If you're a parent and you are going to give your child money for a down payment, let's say you're planning to give them 20% down in California, which is, a couple $100,000, and you're freaking out, what should you know about gift tax implications in that scenario?
The good news is when someone gifts you money, you never have to pay tax on it. So I don't mind if your parents give you 10K or a million, that's tax free for you. But on their side, if it is over the gifting limit, like this year is 19K, if they do gift you over the 19K per person, so technically your parents could give you 38K. If it's over the 38K, they will have to file a gift and trust or gift and estate tax return. Now, they're not going to pay tax on that unless they're over that 15 million exclusion. So unless they've gifted so much throughout their life that they're above the limit now, but it's more of like an informational return that they would have to file every year that they gift anyone over that amount, because it's the IRS's way of tracking how much have you gifted in your lifetime, because when you die, we're going to take that from your 15 million exclusion.
Love it. So as long as they're not going to give you more than 15 or 30, depending on single or combined, in the lifetime, not just at their death, you're fine. Or they're fine.
They're fine. You won't be taxed on it, but they will, or could be.
I love it. Cool. Well, let's go into one of the favorite topics here, depreciation. I don't even want to say anything on this. I feel like I've learned so much about this subject. Most from all the people I've learned from this, you've been the one I've learned the most on it. So take it away. Tell us what this depreciation thing is.
Oh my gosh, it's literally the best year to buy real estate in the last, I don't know how long. But if you are thinking of an investment property, you can now take 100% bonus depreciation. So let me first tell you what depreciation is, and then we can go into bonus depreciation. So the IRS says when you buy an investment property, you get to depreciate it over 27 and a half years if it's residential, 39 years if it's commercial or short-term rental. So meaning you buy something for 390K and it's an Airbnb, you divide that by 39, you get to take 10,000 a year as like a free deduction. So the IRS is just saying, thank you so much for investing in our economy. Thank you for providing safe housing, because we don't want to do government housing in the US. And because we don't have to do it, we're going to gift you 10K. That's great, but 10K is not going to cover all the rents that you're going to get throughout the year. So you want bonus depreciation, which just means instead of 39 years, maybe the IRS is going to let you take it over 5 or over 7 or over 15. And that's our job as your accountant. We're going to do what's called a cost segregation study on the property. And we're going to say this whole building is not 39 years. Like parts of it is, but we know that windows don't last that long. We know floors don't last that long. Definitely paint and drywall and screws and lighting don't last that long. So we pick apart every single piece in the property and we say, okay, and this is very estimated, but let's say it's usually about 25% of the purchase price. We can depreciate it this year. So on that 390K property, instead of a $10,000 deduction, you're going to get probably a $100,000 deduction. So you just 10x your deductions just for having us do a cost seg study. And by the way, last year it was 60%. And this year, before the tax laws changed, it was only 40%. So you were only going to be able to take 40% of that 100K. So 40K. And now this year you get to take 100K. So it is a very big deal. Like real estate investors are eating this up. And it's really important when you're deciding whether or not to buy a property. Maybe it doesn't cash flow the way you want it to, but add in the tax benefits and it probably makes sense on paper.
How is this applicable for residential compared to commercial?
Can't do it. Well, for residential, I mean, you can't do it for your personal house, but for residential, like you're just renting out a house long term, you can do the exact same thing. It just is anything 4 units or less and anything not short term.
Okay. Sweet. And we'll go into some of those scenarios a little bit here in the real life pieces. The depreciation piece, guys, I just want to kind of clarify. I've come across a lot of clients who are like, oh my gosh, and I should say a lot of clients, but this is still uncommon, right? Like I'm talking about like I've come across, 20 so clients out of, the hundreds we've served. The majority of those don't like their CPAs. So if you don't like your CPAs, speak to Barb. But for those that I have spoke with, that lesser amount, that are like, oh my gosh, I love my CPA, but they've never talked to me about this bonus depreciation thing. One of the things I would encourage is if you do have a property you want to analyze, if it's going to make sense to do a cost segregation study, chat with Barb and their team. They've been fantastic at even just helping with that specifically. And if you're like, oh, I want to leave everything else the same, cool, no worries. But speak to them about the cost seg, because I personally did it and I went through the questions and went through all the pieces. And I was blown away at how much it saved me, especially that year. The rents were not good in the short-term area that I was looking at. And so if I didn't have the bonus depreciation, my loss would have been terrible. This saved my rear end. So can't encourage it enough. Make sure to speak with them. Bonus depreciation is super, super important. And Barb, if I understand correctly, doesn't the IRS like require you to take depreciation on a property?
Yeah, what's crazy is like if you were audited, the first thing the IRS looks at on your rental schedules is have you taken the appropriate depreciation? And they do this sneaky thing where like they will calculate what depreciation you should have taken by using a cost seg. So if they're like, this person didn't do a cost seg, they didn't do the depreciation right. And they're trying to save their deductions for later, and that's illegal. So we're just going to take away all their depreciation. And I've seen that happen with clients. So you actually have to have a cost seg study. So don't let your accountants tell you that you shouldn't have one or like it's not going to be worth it to you. It's actually like you have to have it. And to my point on like see what your actual ROI is on the property, I put in the chat here, I have a free rental analysis calculator, and that calculator will calculate your real ROI is what I call it. So it takes into account the cash flow, the appreciation of the property, the bonus depreciation that you get, and the mortgage pay down. So you can just download it for free. And that's how I analyze any properties that I'm going to buy.
Love this. I'll make sure to share this in the follow-up and the recording with the slides as well, too, team. Okay, so let's go into the last piece. From what I was reading, there's a lot of updates that give builders a ton of incentives as far as like creating housing with affordable housing and different incentives with builders, right? You taught me this specifically, that the key to understanding tax strategy is knowing that you're playing the IRS, the government's game, and whatever rules they create, if you find how to just enjoy those rules, you'll be extremely successful. And so, like Barb was saying earlier, the government doesn't want to make housing, but they want you to make the housing. And so what they created, at least from my understanding, for builders is some really cool incentives. I mean, just even no further than a mile from here, I just saw a builder buy a massive property. I don't know if you guys are familiar with the channel TBN. It used to be this really big, charismatic TV channel, and their property was bankrupt. This one commercial investor bought it. I think he bought it for like 20 something million. He just sold it for like 44 million to a new build developer who's going to make part of that affordable housing, and then the rest is just going to be luxury townhomes. And so when I see that, I wanted to put this in the slide specifically because I think the important part is this: what we've discussed already so far, and we're going to make it be practical here in a moment, but what we've discussed so far is tax strategy available to you today. And I want to make sure to point this out because I do believe that this is the foundational piece of a window that's going to get more and more intense, right? The window of opportunity where we can try to negotiate credits, get really good deals, see people in scenarios where they have to offload parts of their portfolio, be able to take advantage of your equity with rates that will be declining over the next few years. That opportunity is now. the more that other builders are coming in and these big companies, like we've all heard about the, BlackRock purchases and all these different things happening in the middle of the country where tons of homes are being built with a community that are just going to be for renters, right? These are all signs that housing is going to get more and more competitive. And so I just want to take a moment and say, if you are considering, or if you have clients considering moves, don't be so narrow-minded to just take the perspective of, do I like a house or not? These are financial decisions that might not be available to people in the same way 5-7 years from now. And these financial decisions can truly make a difference in the life that the grandchild of your own life or your clients' lives will have right now. So I can't emphasize it enough. I do think this is a window of opportunity, and credits like this for me just reaffirm that. Barb, anything to share as far as like the new credits that are being given to builders and all the incentives that the IRS is giving housing right now?
Well, just use your analysis of that building that you saw that was just sold, and they're going to turn it into low income and luxury housing. So probably at least what they should be doing. So this applies to any developer, and you could be a developer, which just means you're going to, fix up and sell a house. But do what's called, there's a recycle and rehab credit. So this guy that probably purchased a big building for a lot of money, 44 million, what they're going to do is get a cost seg study so that they segregate everything that's in the old building. They're going to donate whatever they're allowed to donate to charity. So they're actually going to take pieces of this building and donate it. So they're probably going to get like a $20 million charitable deduction since they bought something for 44. Okay, that $20 million charitable deduction is probably going to fund their construction loan that they're going to need on this. Then they're going to get tax credits for the low income housing that they're building. And if it's not only low income, but also there's, energy credits, and, if you make it energy efficient, they're also going to get that on both the low income and the luxury housing. So like, these are all available to you. It's not just available to this $44 million person buying that building. You can do it on one single house. We just had one of my clients, she's a developer in Scottsdale, and she likes to buy houses and just completely tear them down and rebuild a new one. So she bought one for $1 million. She just got a $600,000 charitable deduction because she did this strategy. That $600,000 charitable deduction funded the down payment on her construction loan that she's then going to build and sell this place for $10 million. Like, it's crazy, but you have to know how to play it.
That's huge. That's so good. I love that. Yeah, Barb, I think you'll know the building. It's right across the street from South Coast Plaza. It looks like a crazy white house, like a mansion. That was the old TBN building that was just sold. So I'm really stoked to kind of see what is going to be of it. Now hearing that, I'm like definitely jealous, but inspired. So as far as getting some inspiration, let's talk about real life scenarios, right? You might be the person who has a ton of capital and you're wanting to just continue the building world. We have clients that are in that space. You might be the person who, even unknowingly, you forget you have hundreds of thousands of dollars to your name. It's just frozen in your house. Whichever side of the spectrum you're on, I think talking about some of these real life scenarios should be inspirational for you no matter where you find yourself. So the first thing that we'll talk about is, like, in 2026, what should clients think about if they want to move out of their current home, rent it out, and buy a new one? Meaning, what should they know about the home they're turning into a rental? What should they know about the home they're buying next? And so this scenario is super common for us. Barb, we served 18 families last month specifically, and 3 of them were just investment properties. 2 of those investments were some of our clients paying off hard money construction loans for luxury homes they bought, and then 4 of the clients were move up scenarios, where they were converting their current house that had a ton of equity to a rental. And many of them tapped into that equity even through home equity lines of credits or cash out refinances. But I'd love to know, if somebody here is contemplating, should I make this move or not, aside from the financing pieces, what do they need to know about taxes on their departing residence that they're converting into a rental, and any taxes on the new house?
One of my favorite strategies out there is, if you want to upgrade your home, like move to a new home and rent out your old one. So many people just think like, oh, I'm going to sell my old house and buy a new one. But the real way to build wealth is if you can hold on to that property. And to Sosie's point, you probably have hundreds of thousands of dollars stuck in equity. So take out a HELOC or cash out refi or something from that house before you rent it out. But you're going to have that HELOC, which can probably fund the new house. But when you rent out your old house, now you just unlocked so many tax deductions, that bonus depreciation we were talking about. You can now take that. But also, you still get to take both the personal residence exclusion and the deductions if you like sold the house before the 5-year mark. So let's say you were in your house for 2 years and it went up from 500K to $1 million. Well, if you sold it, you'd pay nothing in tax because of the personal residence exclusion, but you decided to rent it out and take out the equity. So you rent it out for 3 years. If you sold it at the 5-year mark, you still get the 500K exclusion and you still got all the depreciation from renting it out and you got all the rental income. And now it's probably worth 1.3 million.
Huge. And putting some more color to this in life, in real life too, guys. And again, this is all stuff that I've just like learned so much from Barb on. When you're looking at what you should do, one of the biggest hesitance. First, I'll share this. I have so many buyers who are so focused on cash flowing on a new property, they forget that the best cash flow is typically the primary residence you had with the low interest rate and moving out of it. Like it's sometimes the most obvious, but the most obvious many times gets the most overlooked. And so I'm very, I would advocate for this a lot. Check to see how you would cash flow. And if you're thinking about cash flowing as a long-term tenant, go to RentCast or Rentometer. If you're looking at cash flowing in short-term, check out AirDNA to just kind of see what the numbers could potentially be like. If you don't have a report for it, send me a DM. I'll send you a free report that I have for our past clients exclusively for those, where we'll put you into our AI system. They'll give you potential rents on long-term, short-term, equity positions, all that kind of stuff. But all that to say, when you're looking at renting it out, the thing I love about the part that Barb just said, that 3-year timeline, right? If you've lived in the house for the most recent 2 out of the last 5 years, you can still do the primary exclusion. This is also a really cool way for you to even test if you like being a landlord, right? Like I've had clients that are so focused on the sexiness of being a landlord and all these pieces that sometimes they don't realize that their personalities, their lifestyle are not going to be, really set for it. So this is a really cool way for you to go, okay, I have one that I already know the maintenance issues with it because I've lived in it for the last 5 years. I have one that I know is going to cash flow because I have so much equity in it and I have a low interest rate locked in. And even with me pulling on my HELOC, my renter's money is still paying for the old loan and the down payment for my new loan. So I'm set there. And then you have an ability to test for 3 years, right? Because you can move out of the house and up to 3 years after you move out, sell it, and then take the money that you save without having to pay capital gains on it. And if you fell in love with renting, but you realize you don't want to rent in that area anymore, right? Maybe you're like, we've had clients who rent in California, they're cash flowing, and then afterwards they're like, screw this, I don't want to do California anymore, I'm going to take a different one. Guess what? You don't have to do a 1031 exchange. You don't have to do anything with loops or, trying to figure out stuff out. You can use that money for anything without the tax implications because it was the primary. So I can't emphasize that enough. It is the best trial run to being an investor that's out there and gets way too overlooked.
Let me just add to that. So as someone that has a lot of rental properties, I will say, yes, test it out, but also know that one property does not mean that the rest of the properties are going to go that way. And I just say that because maybe you rent out your primary and like a pipe bursts, but the more renters and rentals you have, the liability spreads and, the cost spreads across the properties. And so like, don't let one bad story, make you not want to be a renter. We have dozens and dozens of properties and stuff goes wrong all the time, but we know that the other properties are going to cover those expenses. And you're always, you might have a crazy tenant, but again, the other 50 tenants are great.
I love it. Yeah, that's really great. Last thing I'm going to share on this real life example, especially if you're a professional guiding clients through deciding if they should sell, not sell, rent, not rent type of scenarios. The last thing I will just share on this is going to be specifically to making sure that individuals make decisions with more information, because well-informed decisions are the ones that they usually regret the least. And so instead of just like, do I want the new house right now? Especially when they look at where rates are at, what their payment might be on the next one. Again, running the scenario of how much can I get in tax benefit? And Barb, I'm just going to say this in assumption here, and then please correct me on the pieces. But running the scenario of like, hey, if I rent out my property, can I now do any cost segregations, especially if it's a short-term rental or something like that? Trying to exhaust all the tax benefits of the departing residents, right? Running that figure plus knowing that the loan that they get on the new house, yes, it might be higher. It might be a higher interest rate than the low rate they had, but at the end of the day, now they can write off mortgage insurance if they're going to put less down. They can write up the loan interest up to that 750. So a lot of times I see consumers specifically make a decision that they think is net a negative piece to them on a monthly cash flow scenario, but they haven't ran the tax numbers. And actually with the tax numbers, they're positive. And they're allowing themselves to miss an opportunity where right now it would be uncomfortably comfortable. And so they're like, no. But if they realize the uncomfortably comfortable is a bridge to amazing because of the appreciation they're going to gain on both assets now, leveraging one to another, it's a game changer. So don't let clients make decisions with emotional information. Please, please, please make sure you work with individuals, especially like Barb, who can help analyze things from a numerical situation too before decisions are finalized.
Exactly. That's why I created that rental analysis calculator, because it puts the tax benefits in there, which most people don't take into account. So there's so many ways to win with real estate. You just have to know how.
You give a lot of great stuff, Barb. Thank you for that. Last question for you. If somebody did do a cost seg and they did bonus appreciation on departing, and then they have the $500,000 exclusion, I'm assuming they have to pay back that depreciation somehow, or is it fully just covered in the 500,000 capital or the exclusion?
It depends on how long they're holding the property, and it depends on what life we classify each of those units in the house. So there could be some depreciation recapture, but I always tell people the time value of money, like I don't care if you have to recapture depreciation later, because you get the deduction now. And if you did an actual calculation of time value of money, that money is worth way more to you now. Who cares if you have to pay it back later? And depreciation recapture is capped at 28%, whereas all of our tax brackets could be over 40. So you're actually playing like tax rate arbitrage and going from a 40% bracket down to 28. So like, don't let depreciation deter you.
I like that a lot. And I'm going to start expanding a little bit more on time value of money. I think it's a concept I freaking forget so much. All right, so we got 13 minutes left here, guys, and we're going to go through these last two scenarios a little quicker. What should clients think about if they want to use the equity in their current home to buy an investment property, whether it's long-term, short-term, mid-term, commercial, multifamily, residential? I'll share a little bit on my pieces. What we should always be looking at when you're looking at, okay, I have a house, I don't want to move out of it, I have hundreds of thousands of dollars of equity, I'm making a ton of money, W-2, like what do I do? First thing is let's try to find two parts. And this is what I kind of help clients navigate. Number one, what would you be comfortable with from a numerical standpoint, right? A return of money. What are you looking for there on that return of investment? And then in addition, what are you looking at return of energy wise? How much are you willing to provide right now energy if you want to do a BRRRR method, meaning you're going to buy, rehab, do a full gut? Do you want to look at syndications? Do you want to look at high amounts of energy or low amounts of energy? So I will suggest that right off the bat is when you are looking at, I need an opportunity because I have a massive tax bill, I have a ton of money, and these two things married together can actually create a lot of savings for me. My guidance on all that is always find what is going to be desire for money and energy, because both of those are going to be super, super needed to make this a long-term play. So many people give up after their first rental property because they went on one that took too much energy, right? Mm-hmm. So be okay to know that there's steps in the game, especially when it's about your life, like identify that for yourself. Barb, all you.
I think you said it perfectly. I call it return on investment and return on energy. And for us, like how we invest, I'm not a short-term rental investor. We have a couple. I don't love them. I am like all about long-term rentals, because the more properties I can get long-term and I really only have to, deal with them once a year to turn them, the better. But there are investors out there that all they do are short term, or there's investors out there that all they do are midterm. So find your niche, find what you love, and just go all in on that. Don't try to do all these at once. You'll fail.
A couple takeaways too, as far as case studies for everyone here on the call, that I think are worth highlighting. Number one, you have an opportunity right now. When I talk about window of opportunity, especially right now, you have a window of opportunity to, and again, Barb will correct me here, to buy a rental property right now. And if you're not a short-term fan because you hate the work of it or whatnot, but you've been doing the work throughout the year, you're pretty much in line to qualify for something called a material participant, or qualify as a real estate professional through the material participation loophole. Meaning you've done your 100 hours, you've confirmed with your CPA all the other things that are required, because it's not just always as simple as one checklist piece. My whole message here, after all that disclaimer, is this: investors right now can buy properties with their intention of putting them in short-term rentals, and in this taxable year be able to qualify potentially for a cost segregation that they can't next year. So for example, clients have bought houses, put them into service this year, and then next year if things change, they're like, yeah, Barb was right, I don't like this short-term game. They can convert it to a long-term property next year, but still get the tax benefit this year. And so I'm going to throw that out. And then the second thing I'll throw out is don't miss opportunities in your state, right? A lot of people are leaving their houses right now and they're cash flowing $100. But if they would use their equity to put a midterm ADU and then a short-term junior ADU, they could literally create all three: long-term, midterm, short-term. I've had a couple clients actually do this, 2 clients specifically, and their cash flow went from like $100 to 800. And so try to consider all these pieces and the tax savings on it, because again, there's so much opportunity and people are just not taking the time to learn it. And professionals are not taking the time to learn it for themselves and then teach it. So Barb, anything I said wrong there on the servicing for the short-term rental this year?
Just make sure that your intention of the property is short-term this year, if you're going to do the short-term rental loophole. And next year, your intention has to change, but you didn't know that your intention was going to change next year. So the IRS will dig into it if you're just trying to do the short-term rental loophole one year and not the next. So maybe it has to truly be like you tested out short-term this year, you didn't like it, and you moved into it. Or like for us, we had a short-term rental. It was taking too long to get the short-term rental permit, and so we converted it later to a long-term.
I love it. Good stuff. All right. Last example here in the last 8 minutes, 4 questions. In 2026, what should clients consider if they want to review or update their real estate portfolio for future estate planning? If they plan to sell their property in the next 5 years, if they plan to keep it, keep their properties and never sell them. So a couple things that I just want to throw out here is, again, if you are planning to sell any of your properties right now in the next 5 years, I think it's a way more responsible and financially savvy move to sell those sooner rather than later, not because of prices going up, not because we're thinking prices are going to drop and if you sell it now you're going to net more. The big reason I have this conviction is because our belief is over the next few years we're going to see rates continue to decrease. And so if you want that lower rate, what is going to be a guarantee of you getting that lower rate, or more of a guarantee, is buying something now and refinancing into that lower rate later, then trying to wait with your low rate and buy later with low rates, because buying in low rate economies mean higher prices, outbidding each other, all this type of risk. Buying and refinancing in lower rate economies, a refinance is much more guaranteed than trying to acquire and purchase. So all that said, if you're looking at offloading properties in the next 5 years, I, again, 100% encourage analyze doing that sooner if you're looking at the 10, 15-year saving mark, so you can try to just solidify those savings through lower interest rate pieces. And then as far as the keeping your properties long-term, here's the fun part, right? And I am inspired because I see Barb play in this world. It's really neat to just see when you leverage your tax strategies and you're able to move money from this, and just see your money work for you, and then see your money create more workers for you that work for you. It's a beautiful gift because you can put money into an opportunity zone and be able to see that capital gains be washed out after 10 years. You can continue to do 1031 exchanges. You can do all these really cool pieces and get tax benefit if you're a W-2 employee, or even if you're not. But here's my whole point. You can do all this thing where you play and enjoy in your life And then ultimately you can give all this to the next generation of whoever you want, and they get to benefit too. Like the fact that you get to transfer, not just break a generational curse of financial habits that we've been born into, many of us have in our families, but we get to change those generational curses into generational blessings by now transferring generational wealth. I mean, it's a massive game changer. So if you are looking at your property portfolio right now, check to see you have HELOCs on all the properties. There should never be a property you don't have a HELOC on, meaning just the ability to pull out money. Don't worry about pulling the money out. Just give yourself the ability to be your own bank. Second, make sure that you have looked at the proper LLC structures with all of them and the proper trust structures. And then third, make sure you're analyzing moves in between the assets before with your CPA so you don't actually put yourself in any trouble. That'd be my guidance on this.
Love it.
Cool. All right, Barb, anything else to add on this last case study?
No, you crushed it.
Sick. Thanks for all the lessons. All right, guys. I don't know if anybody here has questions. It looks like we've kept all participants the whole way through. That's great. I know we have a lot that are going to get the recording too. Any other questions with any of these pieces? Or Barb, do you feel like there's any other part that we should expand upon for people getting ready for this window of opportunity next year?
One, let me just say, in case it wasn't in your slides, that this was not tax legal financial advice. So just so everyone's clear on that. But the window of opportunity for next year, I mean, for the last 5 years, bonus depreciation has gone down every single year that goes by, and next year it's not. So it really is the best time this year and next year to buy investment properties. And to Sosie's point, like, don't let interest rates deter you from buying, because higher interest rates, or what you think are higher interest rates, because they're really not high right now if we compare it to like what our parents mortgage rates were in the 17%. But don't let interest rates deter you from buying, because right now you have less competition and you can always refi later for lower rates.
I love it. And last question for me, and then we'll jump into these last ones here. Barb, you've explained it so much better than I've been able to. So when somebody's comparing having a 6.5% interest rate on a mortgage, right, compared to a fully paid off house, why is it smarter to have the mortgage?
Okay, a few reasons. We're really big real estate investors, and we don't have a single paid off house, nor will we ever, because one, if I have equity in a house, that just means the bank is going to lend out my equity for them. So I'm making money for the bank, and I would rather make money for myself. So I will always take out HELOCs on properties so that I can use that money. It's tax free. When else do we get tax free money in our life? Unless it's a loan on a house or you die and your kids get life insurance, but like we don't want the latter. So get that tax free money to invest more. But you also don't want a paid off house because of liability purposes. If, God forbid, like your kid gets in a car accident when they're 16, then that whoever they got in a car accident with, the first thing they're going to do, their attorney is going to do, is see what assets do you have. And if they see you have a paid off house, trust me, they're like, cha-ching, we're going after them and their paid off assets. Whereas if you have a loan against it, they're like, oh, that property isn't really theirs. So the bank is going to fight us on having to take that property, and they likely don't want to go against a bank. So just for liability purposes, it's good to have loans on your property, and you get to deduct the interest for the most part. If it's a personal residence, you still have the cap of $750. But if it's an investment property, there's no cap on the interest. So you get to deduct all the interest, no matter what it's worth, no matter what the interest rates are. So
I love it. Yeah, I actually had a client ask me this week to make sure that I was answered on this call. They were thinking about pulling money out of their primary because financing in the state that they're trying to buy a property in is a lot harder. Is there any way to pull money out from a primary and provide a loan to the rental company or the rental business to acquire that next asset? Do they have to create a lien on the new property from themselves? Is that even a world that they should be navigating?
you can do that. You'd want to structure, probably make sure the primary is in a trust or an LLC, and then the new property is in another LLC. They might want to have a loan company or a holding company or a management company. They can do it a bunch of different ways, but yeah, you can set up all kinds of loans.
I'll send them over to you to get some more clarification. And then what if your parents what if your parents put you in a trust? How does that change your capital gains? I mean, from my understanding, again, not a lawyer, so I love Barb's always reminder of those caveats and disclaimers that are real. That shouldn't impact anything as far as like the inheritance piece, from my understanding, just because you're not a legal owner, right? You're just going to be on the trust as somebody who's been designated to get the inheritance. That's the whole purpose of it.
Yeah, I mean, the trust is going to get your stuff out of probate, so that's the perk. But the taxes are the taxes. So if it's less than 15 mil, you likely won't have tax on it when you inherit whatever's in the trust. But if it's over that amount, you will. The key to trusts is like it's not going to save you in tax, but what it is going to do is get you out of probate. And the only people that win in probate are the attorneys. They charge you based on assets that are in probate. It's a lengthy process. It's annoying. As Sosi mentioned, like his dad passed away 17 years ago and they're still dealing with this. Like that's crazy. And it's just like emotionally draining. Um I have to
Yeah,
hop off, but if
no
anyone has
worries.
chat
You're all good.
questions, just DM me. And
I will.
it was so good to see everyone. All right, bye.
Cool. Same here. All right. See you later, Barb. All right. So last few questions here. I have 3% mortgage, about 200K equity. I want to build a loan and build the new home. Well, that is a great one for her. So I would definitely say send her a DM with that piece. And I know that she'll be able to get you some good information on that. Rent out my current home, which would net around 1,000 over a month payment. What is the best way to maximize the scenario? So yeah. So one of the things that I would share there too, guys, is making sure you're analyzing how much would it cost for me to add an ADU, a junior ADU, because if you can convert a single family residence into a triplex and make something like, if it's cash flow in 1,000, right? That's where you want to analyze what is my best use of that 1,000, just pocketing it or using that money to reinvest into an additional loan, whether it's a second lien, a HELOC, or a cash out, and then use that to create an ADU, a junior ADU. And now my 1,000 might be turned into 1,500. Now my 1,000 created an SFR now into a triplex, which could appreciate higher, right? Those are all the pieces you want to start with first. So my encouragement would, if you trust us, jump on a call with us, send me a DM, we'll set up a consultation. If you have somebody else you already work with, just work with them to run those numbers of what that hypothetically could look like so you can decide from there. Do you guys do taxes? I don't do taxes, but Barb's team does. They are a tax strategy and tax filing firm. So definitely DM her for more information on that. And I think that is it. All right. Well, guys, the last thing I'll say, that chat about the trust implication, what I was comparing that to is not the trust creating tax benefit, but compared to just getting on title, right? Getting on title is going to trigger tax pieces for you as far as the inheritance piece goes. Staying on the trust doesn't trigger it. So that's where the concept of some savings there for you from a tax standpoint should be understood. All right, guys. Well, I appreciate everyone being on this call. I think that is all the questions. I look forward to more conversations, and I hope you guys all enjoyed. Have a great one, guys. See you later. Bye.